Good afternoon, and welcome to our podcast, the Real Estate Podcast with Paulo Schneider, right here in beautiful, sunny, not so sunny today, Florida. And today we're going to have an outstanding program for you, which is going to blow your socks off. So connect, go online. Right now we have Facebook, sign in through our channels, through our YouTube channel. Check in, sign on, subscribe, and you want to watch this video if you are a real estate investor right now or you want to become one. These are things that you need to know, and you want to archive this video, this information that is going to be brought to you today. It's going to be something that you probably never seen before. That's how important this is for you all out there who think about investing in real estate, who are real estate investors, and anything you want to do with, even if you rent your own home at some point and for an extended period of time and you want to sell it, and once you record that rental income to your taxes, you most likely could be taxed. And we're going to talk about this. We have one of the greatest experts of all time here in our studio, and I am really, really honored to have him in here. I had to really beg and work hard on him to get him over. And I tell you, I wrestled him in today. I told him I will offer you a good caipirinha, a good barbecue, and he said, I'm in it, and we are going forward. So let me introduce you to our great guest, Drew Monaghan. He is a outstanding professional. So let me read you a little bit about his bio and what he's done over the years. And then we're going to go right into the subject, which is unbelievable. You don't want to really miss it. And by the way, if you have friends out there that are investors, share this video with them. This is your obligation, because people need to understand, they need to know how this process works, unless you love to pay taxes. I don't know about that, but the answer is most likely no. So if you have good friends out there that are investors just like yourself, send it out there, pass it on, because this information is incredibly valuable. So here we go with the bio of our guest, our honored guest, Drew Monaghan. He is the president of the Private Exchange Group, Inc., a national qualified intermediary for 1031 exchange. That's a big deal. Since his graduation from Notre Dame, wow, that's a different story. Notre Dame, voila, man, that's a Ivy League school. That's not for everybody. That's for a fortunate few right there. And this tells you the caliber of our guest today. Thank you. Drew has held senior level positions in large and public-private companies. He has been the president of 2 Rotary International clubs and has served as the district governor of Rotary District for 6990 in Southwest Florida. Well, that's in Grand Bahama. That's great. Yeah. So not only you are a businessman, but you do a lot of volunteer work. That's awesome. Absolutely. So you investors right there, you see what we have here? He's not going to just sell you, but he also does contribute to the society. As a business development executive, Drew has managed multiple teams to the highest level of accomplishments in their respective fields for over 35 years. Some experience right there, Drew. Yeah. The success of the teams he has coached have been due to a strong work ethic, respect to each other and the company, pursuit of excellence, client-centered focused, and consistently delivering value. Very, very important. People, that's what people look for. Value. What can I get out of this? It's very, very important. As a sought-after 1031 exchange expert, Drew has consulted and trained thousands of CPAs, attorneys, brokers, and investors on the strategies and options of 1031 exchanges over the past 20 years across the United States. Wow, that's very important. Drew has the unique ability to present complex materials into simple. That's a fact, because I've seen it in person, and that's why he's here. Easy to understand, an easy to understand way. After his consultations and training sessions, his clients and their teams have a clear strategy and are able to use the tools immediately to help their business and families. And that is true, because when I walked off that meeting of the lecture you gave, I knew, actually, not when I walked off, when you said the first couple words, I knew that you knew your stuff. So please help me welcome our big guest for the day, Drew Monaghan. Welcome, sir.
Thank you, Paulo. Wow, I'm blushing from all that you read there and what you said. Thank you.
But it's true.
Big shoes to fill. Anyway, so I want to get right into it, right?
Let's
I want
go.
to cover this. It's called 1031 exchange. We're going to cover all what that means and how to use it. But I have three concepts. We're going to talk about what it is as a concept.
Right.
We're talking about the process, just a little overview, and then the benefits and who can benefit from it, right? Just like we talked about before.
Perfect.
So the concept is basically deed swapping. So the numbers 1031 come from the United States Tax Code, Section 1031, that allows this to happen. So basically what they're saying is, they're saying, wait a minute, if you're a real estate investor, so you own a property that you use to make money, either by renting it out or by running a business out of it, you can actually sell it and exchange it for other properties used the same way and not pay any taxes, because you're literally just reinvesting all the same money back into other real estate. That's the concept right there. It's pretty straightforward. It can get pretty complicated depending on different situations, but the concept always stays the same. And that's really what it is. It's the ability to repurpose your assets from one to the other without having to pay a tax each time.
At
and
the
make
time
them
of
stronger.
the transition of the sale, or
exactly, yeah. So because
the
normally,
property.
if you think about it, you ever play the game Monopoly, right? You know the
Right.
game Monopoly. It's internationally known. So if you look at Monopoly, you have 4 greenhouses you build up, you swap them for the hotel.
Okay.
Why? Because the hotel, you like a little red hotel, maybe, but you also like the red hotel makes more money than the 4 houses did.
Absolutely.
Because the rental's more.
Exactly.
So that's one example of many different combinations that somebody could take advantage of should they want to do this. So the key takeaway is 2 things. One, it is a concept that can apply to somebody if they qualify. And 2, it's a way of removing or repurposing or enhancing, strengthening, moving around their portfolio, even if they only have one property, to make it stronger and better. Yes, you're going to defer the taxes. You're not getting rid of them. You're just rolling them forward, kind of like a 401k. But you're doing that every time you make this move. And the most important thing is the taxes are kind of secondary. The biggest purpose of doing this is strengthening that portfolio. You're actually doing something that makes it better, whether it's more rental income, easier to manage, or no management. Maybe you go into a triple net type thing. Or you're relocating, your family, your business, whatever reason.
From one state to another, right?
Exactly right. And you don't want to pay taxes by transitioning all that. Or you just want to consolidate. Maybe you have all these properties and they're in different areas and it's becoming too hard to manage that. Right?
So right there, the folks that live up in the cold areas of the country,
right.
And if you don't want to shovel snow anymore at your properties,
right.
move it down here to the sunny states. We'll help you out with that, right?
I think people are still doing that.
Oh,
actually,
they are
right?
doing it, but we need to find out who they are. Let's connect with you.
So that's a key example. It's relocation, right? And in Florida, we don't have any capital gains tax. We don't have state income tax. So that's part of the attraction of coming here.
That is true.
So you can't take your properties with you, but if you sell them in a different area, again, one or more doesn't matter, you can reinvest them here and save that tax and strengthen your portfolio just by that one move. So another idea would be diversification. Let's say I don't want all my eggs in one basket, so I want to be able to take, okay, I have let's say a multifamily, right? And I'm like, you know what if something happens to that? Maybe I want to buy 2 or 3 properties.
Separate
so
properties.
Separate types of properties. Doesn't matter the type,
okay.
Right? I can actually reinvest them, and now if something happens to one, I'm not out of income. So the opposite of that also works. So consolidation is one way, diversification is another way. So I'm just giving you some ideas. We'll get to more later of different scenarios, like you have real world stuff. But the concept is, again, about swapping properties one for the other, and then being able to take a tax deferment of that so you don't have to pay the taxes, so you have the maximum amount of equity going forward. Go ahead, you had a question.
You can utilize it to buy a property equal to
or greater.
Or greater than what you sold it for.
Exactly right. So that's kind of the overview of what the concept is. It's been in the tax code 102 years.
Wow.
So it's not a loophole.
Wow.
It's not something.
New.
No, it's been. So the basic concept, let's say you and I decide to swap a deed with each other, right? And let's say your property's worth $500,000, mine's worth $500,000. If I sign over my deed to you and you sign your deed to me, there's no money in the pocket, so nothing was created. There's no profit. There's nothing to tax.
No tax.
That right there is the concept of why this works. So the government's not giving you a freebie. They're not saying, oh, great, Paulo, you did a great job, so we're going to give you this free little exchange here. That doesn't work like that. It's a very fundamental, though. The concept doesn't change no matter what combination you do. So that's always going to guide everything about what we talk about as far as strategies, as far as benefits, right? So that's kind of the over of what the concept is. Pretty simple stuff, right? That's why I want people to get excited about doing this, to say, wait a minute, this property is not doing as well as it used to. Maybe there's expenses. Maybe it's a condo with the HOA fees or the condo associated fees. It's becoming too attainable, or maybe they had some assessments or something like that. They can't make the numbers work. They're having a tough time renting it. Look for this as a solution to get out of something that might not be working to something that is working. Easy example would be also, let's say I invested land years ago. Great, but it doesn't produce any income. Maybe I sell that, just like Monopoly, start with the land, and now I buy a single family home or a commercial property or a couple of them, or or a combination of maybe a residence and a commercial property, right?
Mixed use.
Exactly. So you're thinking of out of the box thinking, I'm here, I'm at A, I'm trying to get to B. Tell me what B looks like. And that's what we spend every day talking to clients about, is that tell me what you're trying to do, and we'll see how this tool called 1031, it's a tool, how it gets you to the next level, right? And that's kind of how the concept works, right? So let's get into the process a little bit. So the process, there's involved some rules, obviously you have to follow.
Right.
The IRS is looking for you to follow a certain set of rules.
Of course.
First rule is you have deadlines, okay? So when you close on a sale, that starts a clock.
Okay.
So the clock starts day of closing, not the contract date.
Okay.
Day of closing. You have 45 calendar days to shop for what you want to buy.
From the day of closing.
From the day of closing.
That's the day when you pass the deed on to the new buyer.
Exactly right.
Okay, so it's very, very important. Like you made it very clear.
Yes.
Not the day you list it, not the day you go on the contract. The day you actually, the process funds.
Exactly right.
And the deed is passed on to the new buyer. From that moment on, you have 45 days to identify another property, to go on the contract.
Well, you don't have to, but you can.
Why you don't have to?
No, that's a great question. So the idea is closing date starts the clock. They give you 45 days to shop. Calendar days, not business days. So weekends included.
So calendar days, no holiday, not
holidays included. No, exactly.
Holidays included. So Saturday, Sunday, not.
No, they are all included.
Oh, so yeah, I mean straight
up,
365 days.
So yeah, so you go
calendar day, 7 days a week.
Exactly right. So you close. Let's say you close today. Tomorrow's day one, right?
So 45 days straight from the day you close.
Exactly. So we call that the shopping period, right? Okay. Where you got to shop for what you want to buy. Now, what the requirement is, by midnight of that 45th day, even if it's a holiday or a weekend, doesn't matter. The IRS has said you want to identify what you're going to buy in writing to the company that's processing us. I'll get to us in a second. But you want to identify what you're going to buy in writing. Basically, we give you a form, you fill out addresses.
Okay.
That's it.
It has to be signed by buyer and seller?
Not seller, just the exchanger, just the person who's doing the exchange, right?
Okay.
So the person doing the exchange is the one who does that, right? And they're going to say, okay, we want to buy these properties. They send us a list, kind of a shopping list now, right? Now, after the 45th day, you have a total of 180 days to close, but after the 45th day, you can't change that list anymore.
You cannot.
No.
So meaning that period, you have to identify the address you want to buy. The property has to be identified by a form.
Correct. And once it comes in, now from day 46 to 180, the only properties you can close on are on that piece of paper.
That's it.
Very critical to be very clear about what you're buying. And I'm going to go over strategy.
Yeah.
With that.
What if this falls apart for whatever reason?
Oh, that never happens in real estate.
No, never. No. Just once every other time.
Definitely not in Florida. Definitely not in Florida. So we're going to cover that. So I'll give you the rules first, and I'll give you the real world and how to handle it. Yeah.
Perfect.
So the idea is that you give us this list, and now you have the whole 180 days to close on it, right?
Okay.
Now, let's talk about what our role is, and then I'll get to the strategy. So our role is called a qualified intermediary. What our job is to do is to facilitate the paperwork, the logistics with each of the closings, the sale and the purchase, right? Because it's sale and buy, you're repurposing.
Right.
And we set up an escrow account to hold the funds, because one of the other rules is you can't touch the money.
Cannot touch the money. It's in an escrow account specifically for this purpose.
Exactly right.
100%.
So we set up that escrow account.
Cannot be commingled for anything. It's exclusive account for this subject.
Exactly right. So you 100%. Know you have an escrow account for the closing. That's just for the closing. And we set up the one for the 1031 after closing. Go ahead.
Right at that time, do you have to advise your attorney or whoever your tax agent or a title agent is to set that account separately? Does it have to be identified in the form?
So great question. So you want to get us, we have to get involved, before anything closes.
Okay.
So the title company doesn't set the account up. We do.
You
as
do.
the intermediary.
I see.
So one of our main roles is that. So we set up an escrow account. That's basically our account for benefit of the clients. It's a trust account. And the interesting thing is, opposed to a closing agent's account, these accounts are separate with every client. So they have their own account separate from everybody else. And then when the exchange finishes, we close the account.
Okay.
So we're in and out of accounts every month. There's a safety aspect to that too. So you don't want to have accounts out there, right? So as the exchange finishes, we close it out and they move on. Exactly.
Move on.
So that's our other main role. So paperwork, logistics, and accepting documents that are necessary for the exchange, and then also doing the holding of the funds and sending the funds for closings. That's our main role. Think of an intermediate between a sale and a purchase. We're connecting the two. So if you think about, remember I said the deed swap, you and I swapping deeds?
Yeah.
Well, you can still do that these days, but most people don't do that anymore. You don't have to find somebody to exchange with. You don't say, well, wait a minute, I want to do an exchange on this property, but who can I find to exchange with me? You don't have to do that. You can sell to anybody you want and buy from anybody you want.
So long as you're within that period of time.
And you have the intermediary coordinating everything.
Right.
That's the key, right? So we're connecting those two closings to a deed swap. That's how we connect that, okay? So part of the logistics is that. So let me explain something else. So at closing, there's documents that we provide and instructions for the title company, and we go through that with them on the phone as well as in writing. We take care of all that for the client. They don't have to worry about that. I want them focused on the strategies, which we're going to get to next, all right? But the concept is there's rules to follow. You can't close and then call us. You can't touch the money, you pay the tax. You have to follow those rules, right? And we help you with that. Now, one of the main strategies is to set everything up as early as possible. In other words, when somebody is thinking of selling, that's when we want to have a conversation.
Very important.
Right.
Not at the time of listing or after you listed the property for sale, but before that.
That's the best.
Call your office or call me, whatever. We get in touch.
Set up a meeting.
You set it up.
Usually, because here's the thing. If you think about it, you know the market, right?
Right.
Is 45 days enough time to shop for a property?
Not really. Not
Could
really.
be tough. Now, if you have a multi-million-dollar property, even worse,
Huh.
right? Or if you have a property
I can tell for a fact I'm struggling for months and months and months.
sometimes to get it, right?
Yeah, the right property is difficult to be found.
So one of the main strategies with that is to understand two things. One, the IRS and their rules do not accommodate for market conditions. They're not going to come back and say, well, listen, Paulo, I know you're having a tough time finding this, so we're going to move this around.
Yeah,
no, they don't do that.
No chance.
So what we have to do is work ahead of that, be proactive. So one of the ways to think about it is I want people to think of selling and buying at the same time. So you're managing a sales cycle with a purchase cycle.
Okay.
So if you tell me it's going to take you 60 days to find a property and 80 days or 90 days to find a replacement, so maybe 60 days to sell and 80 days to buy, you're good to go because you're in that time frames now.
Right.
But without you giving that market data, that's where you as a broker, as a realtor, is critical to give them market data so they understand what they're dealing with. You got to be able to plan this out correctly.
Right.
So if you're buying and selling at the same time, you're going to have no problems with those deadlines. Because here's the thing. You can't change the deadlines, right? But you control when they start. That's the big takeaway.
Well, so that's important. Let me make a note of that because this is so essential. So what you're saying is that start the process of preparation. Get ready way ahead of time before you put the property in the market for sale or whatever you want to do on the planning.
Yes.
If you're thinking about 6 months from now, start today. Start getting into the planning and to make sure that you do it right because when the time comes, you are on the clock.
Exactly right. And
very important.
Exactly. Because what messes up exchanges is the fact of two things. One, ignorance. People don't know about it. That's why.
Or they leave it to the last minute, right?
Oh, my gosh, yes. So
I do it tomorrow.
Exactly, right. Oh, I'm going to put in that bank account thing we talked about, right?
Yeah.
So the cool thing is that you're doing classes like this and education pieces like this because that's the biggest thing that's needed out there is the education piece.
It's so true.
And because once you get the education, every week we get calls from people that are closing last minute, and the stress level can be really difficult. Let me tell you, it's not worth it, right? But we still want to help them anyway.
Lack of planning.
Exactly right. And sometimes they don't know about it. They say, well, how come so-and-so didn't tell me? Well, they might not know themselves, or they might not know that you were thinking that. They might not know what you're trying to do.
That is a point. Is a very, very important point on the perspective side of a realtor. Let me tell you the point that you just made, Drew, is unreal. It's so important because most realtors out there are regular salespeople. It has nothing to do with the profession, but a lot of the people, a lot of them, they go after the commission. That's all they care about.
Right.
And that's just about as bad as it can be. Because if you're not coaching your client the right way, you're not going to see that client tomorrow if you're going to see it through the process.
Correct. And with go ahead.
With the proper planning, coaching, helping your client, bringing the benefits to the table, and make sure that because they hired you, you have to bring your value, your expertise to your client. Bringing somebody like you on the table. Hey, this is an area that I don't understand about, but I have Drew. Drew is the man of the hour for this business. Let's go over, see him, set it up. This is proper planning. This is helping your client maximize the potential of investments and all this stuff, and that affects the family too, because you have to pay tens of dollars in taxes, and that money could have been allocated much better because you were interested in selling a property, not consulting for the client.
Absolutely. And let me add to that. When I get a client that comes to us, I'm talking about team from the beginning. The team is the realtor. The team is the CPA. The team is the attorney. The team is the closing agent. And what I need from them is to understand that everybody's role is critical to making this happen. Not you have to stop everything you're doing, but part of what they're already doing helps. We refer more CPAs than any other category because people think they don't. Well, a lot of times an investor does their own taxes. Don't have a CPA. And I recommend at some point that if they get started a little bit more advanced, to have somebody to look at what they're doing.
Well,
right?
They look at the cost. And they don't understand that a lot of times it costs them a lot more when it comes time to sell properties like these. Then the real cost kicks in.
And I tell them, I'll empower the CPA. Most times the CPA comes to us and asks us questions because they might not deal with it every day. So I'm going to bring them up to speed. We're going to bring up anybody else on their team up to speed so everybody's on the same page. The key is once you set this up correctly, it's almost like dominoes. It falls right into place. And that's what you want. You don't want to be stressed with this. In fact, I want people to have fun with this. This is playing Monopoly for real. You're literally getting from A to B and fixing, enhancing.
Moving the pieces.
Exactly right. If you take somebody, let's say, who had a property that wasn't performing, and they say to you, you know what, real estate wasn't for me because it didn't work out.
Right.
You got to say to them as the broker, you got to say, wait a minute, we're going to find you the right situation, the right opportunity. That maybe wasn't or was at one point, but now it's not. We're going to find you one that does work because at the end of the day, that's what they wanted to begin with.
Well, of course.
Right? So we're gonna help solve that problem. That's the exciting part for the job.
Just because you had a bad experience doesn't mean that this is a bad business.
Correct.
You could have been coached the wrong way.
Exactly.
Okay.
Right. Exactly.
And exactly what I said earlier, being sold a property with the intent of that person that sold you that property just to make that commission.
Yeah. Just to check a box.
Just to check a box. Sign here. You're going to buy. It's going to be a great profit. Well, wait a minute. Let's look at the bottom line of this because every investment has to have a certain return, and that's your goal. Because if you want to sell one property, you want to buy another one with an equal or better return.
Exactly right.
Why otherwise would you sell?
Right. Right.
Oh, I just want to sell because I want to pay the taxes. No, that's not exactly what you want, because if you have an intent to buy something after selling this, you want to make a better investment going forward.
Exactly.
That's just about the goal of everybody. I've never seen, I'm just going to invest to lose money. I've never seen anybody like, that just doesn't happen.
Right.
So coaching is very, very important. Make sure your client is very well situated before you sign that paper on that listing.
Exactly right.
Correct?
Exactly right. And the nice thing, too, is about once we start from that point explaining, well, first I start with what they're trying to do. I tell them you're at A, you're trying to get B. And then we explain how the exchange could help or not. Sometimes it doesn't work for them, right?
Right.
But the nice thing about the benefit, about the process is you control when it starts. You cannot change the dates once it starts. Okay.
There you go. Once you sign the dates right there and you put the date up and you put your signature on, it's official.
When it closes, you've already decided you're going to close. Now, if you need more time, then you can delay the closing.
Okay.
You can wait to list it. You can do your other, like I said, sell and buy at the same time, line them up. Because if I was doing an exchange, that's what I would do. On top of all that, let me add to something for the process side, right? When you're getting to that 45th day, the rules only require an address on a piece of paper. Let me tell you why I don't want them to just do that. Because let's say they put an address on the paper, they get it in, check the box, they were in the time frame, everything's fine. If it's not under contract, then the seller has the nerve of selling to somebody else. they're stuck.
Of course.
You can't change
It
the
happens.
list.
You can't change. You only have one property. Now that's where a question comes in. Can you do 2 or 3 Can you identify 2, 3, or 4 or more properties?
Yes. So
Can you do that?
Yes, and let me explain how that
That's
works.
very important. Listen out. Listen out. Listen to this. This is very, very important.
So
So your first deal falls apart because you didn't scribble it correctly right there, and the seller decided to sell to somebody else because they offered him a little bit more money or came in cash, and you had to wait for your property, whichever, right?
Right.
Whatever happens, a million of things can happen.
which is normal real estate.
Oh, it happens every day.
Exactly.
Happens every day.
So let's back up. So when you sell this property, there's 2 things to consider. The usage has to qualify, which we covered already.
Right.
You're either running your business out of it, using to make money, running the business or making money from rental, okay? Or if it's land, you're holding on to it,
Right.
okay? The second part is the money side, right? It's if it sells for $1 million, you got to reinvest $1 million, whatever the net sale
The
price
whole
is.
amount.
Exactly right.
Could
Now,
you could invest a little less, but you're going to pay taxes on the difference, right?
exactly right. Well, let me tell you where that's not always a bad thing. So we'll get into that, because that's real
Okay.
world, right? First of all, every exchange we do is either over or under. It's very difficult to match that net number because it's not a whole number.
It's not.
Right?
It's just almost impossible.
So if it's over a little bit, you bring the difference like you normally would. If it's under, you pay tax on the difference. Well, sometimes paying tax on 20 grand is better than paying tax on 200.
Oh, absolutely.
So we
100%
always,
right.
but if you're running it ahead of time and you're running the numbers with your team, you already know that going into it.
You know that
so the
up front.
stress comes down.
That's
right?
called strategic planning.
Exactly. So let's add. So now when you sell this, first of all, you can buy any kind of real estate anywhere in the country. If you sell a condo, you sell a commercial property, you sell land, whatever the investment you're selling doesn't matter. The nice thing is you can buy any kind of real property in the country. Does not matter the type. So you can buy condo, you can buy any residential, you can buy commercial land, you can buy a co-op, you can buy a 30-year lease. Okay, anything that's
There you go.
we had somebody's doing
So
cell
long as
towers,
it has a return on rental income.
and it's
It's
considered
a
real property.
Considered real property.
That's it. Now, the second part of that is how to spend the money. You have only 3 options, right? Keep it
Okay.
simple. If it's let's say your contract was $1.1 million and you netted $1 million. This
Right.
the number's easy. That's after closing costs, commission, stock, stamps, all the normal
Correct.
stuff. So you net $1 million, right? Now, how to spend the $1 million? You have 3 options. You can go larger in dollars. Let's say you find a property for $1.2 million, $1.5 million, something larger in dollars.
Right.
No problem. That's option 1.
Okay.
Why would somebody spend more? Not because the IRS is telling them, because the property they want costs more.
Cost more, of course.
Because it makes sense on the criteria.
Makes sense. Has
Right.
a bigger return.
Exactly right. So that's first. Go larger in dollars. Second, buy something around the $1 million. Now, we saw it already. It's not going to match to the penny, and that's okay. But we think of it as a target number.
Okay.
Like a target number is target. We might not hit it, but that's okay.
But
as long as
close
you're
enough.
close. Exactly. Third option is diversify. I want to buy 2 500s, 4
Could do that.
250s. Monopoly in reverse.
Right.
I want to take that red thing and make it 4 greenhouses.
Exactly. You can do that. Absolutely.
right.
100%.
But the key is when we're talking in the beginning, way in the beginning, we want them to decide which way they're going to go. They don't have to rush to do that.
Okay.
And it's better for the broker too and everybody on the team because once you decide which of those 3 directions, then you're only focused on that direction. It saves time. And the focus stays on that purpose, right? So you're not like going back and forth, and that could mess you up on the timing. Remember the deadlines.
Yes.
So the idea is
very
once you
important.
focus on that side, that decision, you stay with it. Everybody's on board. It saves time. You're good to go. Now, when you get to the rules now, let me go back to the rules. Remember I said you can identify properties in 45. That's the
Okay.
limit. They have
Right.
rules of identification.
Okay.
In other words, you can't just say, you know what, Paulo, I want to put any property in the state of Florida.
Mm-hmm.
They won't let you do that without limitation. So they say this. You can put 3 properties on the list without any kind of limitation. As soon as you put 4th property on the list, now they say, wait a minute, we don't care how many you put on the list, but we care about the dollars of all them on the list. So let's say you put 4 properties. They say, okay, now you put 4, it's more than 3. Those 4 cannot total more than twice what you sold. It's called the 200%
Oh, so
rule.
say if I sold $1 million, I cannot have this for the worth $2.5 million. They have to be worth $2 million max.
Exactly. Even if you're not going to buy them.
Right.
Okay.
Oh, interesting.
Yeah. So the key is that's called the 200% rule. So if you go past the 3 property rule, which is 3 or more, 3 or less, then you go to the 200% rule. Now, if you put more than 3 and the aggregate total is more than 200%, now you graduate to the 3rd rule, which you don't want to go into, which is you can, again, put more than 3, identify more than twice the value. But now you got to close on 95% of them. which basically means you don't close on one, you just killed the whole exchange.
Wow.
So the way we approach this, remember, we're always proactive, not reactive. So
right.
we can't change the rules, but we understand how to work them. So here's how we go. Let's compare back to the strategies. Remember I said you have 3 ways to buy properties.
Right.
More money, something larger in dollars, same money, same price they sold for, or diversify.
Okay.
In the first 2 scenarios, the one you're spending more to be a bigger property or the same, you're only buying one property, right?
Right.
So in those first 2 scenarios of the 3, I don't want you to put more than 3 properties on the list. Keep it simple. That's it. And that gives you basically one, if you put 3, it gives you 1 and 2 backups.
Absolutely, because if one falls apart, you have the second or the third one. So you gotta you have you have a 33% chance on each. And
in 20 years, I've not seen many exchanges fail where somebody identified 3 and they couldn't buy even one of them.
Because of that.
Because also with you involved, right? And we're doing this early on. Remember how all this ties together?
Right.
You're already vetting the properties out.
You're vetting it. You're negotiating it. You're looking at it.
Yeah, you're not vetting them out on the 45th day.
Yeah, right.
Let me add to that. What we suggest people do is by the time they get to the 45th day, I want one under contract from you. Not a requirement. It's a recommendation.
Okay.
It's a recommendation in all capitals and in bold print.
That's almost a requirement. It doesn't say so,
it's my highly strong recommendation that I want you to have one under contract. Not rushing to get under contract. Remember, we're starting early. Okay?
Right.
It's best scenario. And I want one backup from you. Minimum 2 if you're going to buy one. You can put 2 backups if you want.
Right.
But that way, to your point, if something happens to the property, like if inspection bad or you change your mind or something happens, you can go to the next one and not have to fear. That's the key, right? On top of all that, if I was doing an exchange myself, I'd want to sell 1 week and purchase the next.
There you go.
Why would I want to wait for income to come in again? Remember, when I sell that property, no rental income anymore.
Yeah, absolutely. You have nothing
so,
to go.
Right. So why would I
if you're relying on that, you can't touch the money. You have to reinvest it, right?
Exactly. So why would I wait?
Because the moment you touch it, it's over.
Exactly. So
you have to pay taxes on it.
Exactly.
Right?
And you don't have the income anymore.
You don't have the income anymore.
So if you do the best of scenarios, I would try to sell and buy in the same week. Now, that's not a rush. I don't want anybody rushing or feel pressured to do that. It's just a philosophy goal going forward. And if you start early enough, like we keep saying, you're going to have the time to do that because you're matching, again, the sales cycle with the purchase cycle. See how this ties together now, right?
Oh, absolutely.
Now, on our forms, our ID form we give them, it's a 1-pager with blank lines on it. Here's what you're going to identify, your shopping list. We add a little bit to that more than most. We're going to tell you, say, listen, if you want to put more than 3 on the list, we have red ink that says, stop and call us. Remember that 200% thing.
Right.
And we want you to put the value of each of those addresses next to them. Either, it's a recommendation, either the list price of it or what your contract price is. That way you can total it up for the IRS and say, see, we're not over the 200% number. Smart. Think about that, right?
There you go.
And you keep that in that list.
Yep.
So this is an interactive conversation we have with clients so that they know going into it, every step of the way, what the next steps are, which is fantastic, right? So that's kind of the overview of the process and some of the strategies, right? Go ahead.
Very important. Can someone buy, for example, you don't doesn't have to be in the same state. Can you pick up a property in one state and one another, identify a third state and all that? You can do that.
Wherever they want to buy.
So long as it fits that criteria.
United States. It's got to be in the United States.
Got to be in the country.
Yep.
Doesn't matter where. Got to be in the country.
Correct.
If you want to cover some of the points that you have elaborated on your forms and sheets and all that stuff, if our engineer can bring them up and
yes,
you can talk about this stuff a little bit and where our guest or whoever is going to view this video can go in and take a look at this checklist and to see there are some self-explanatory questions right there and answers at the same time.
Well, if he wants to put the 10 common mistakes that investors can make.
That's all in there, and it's right there right now coming up. So
one of them, go ahead.
Those are all important features that people need to know. So elaborate on that a little bit.
So we've covered a little bit of that, but let me go deeper now. So one of the things is not being aware of all the process up front, okay? You make an assumption that the 1031 is just something I do after the fact. Sometimes people say to me, well, how much do you charge to hold that money for me? And they don't understand that they already closed and it's too late. It's not just about holding money. It's about all the strategies we just talked about. That's a big takeaway right there.
Pre-plan.
Oh, yeah. Yeah. Another one is somebody thinks that, well, I can just buy first and then add it in there. That's something you can't do. You can buy first, but remember, when you're doing an exchange, the intermediary has to be involved in every transaction before it closes. Before it closes, exactly. So those are a couple of quick takeaways on that. Something else is not getting their tax advisor involved. If it's them doing their taxes, that's okay too. But you need to know the numbers. You need to know what the taxes would be if I don't do the exchange, to know what the benefit of the exchange is in addition to solving the problems that you're trying to solve, right? So sometimes people don't understand that. They think, oh, well, I made $100,000 on this property, so I'm gonna only put that in. That's not true. You got to put the whole net sale price in.
The whole net sale. Minus commission and
regular
closing cost and commission.
Correct. You don't have to do that because that's
say
normal.
The regular closing cost and commission cost you $100, $100,000, all included, right?
Yep.
And you sell it for $1,000,001 gross, but you net $1 million. That $1 million right there is the entire amount you have to put in.
Exactly right.
If you put $980, you pay taxes on 20.
Right. And there's another version of that. Somebody will say to me, oh, well, we originally put $100,000 into the property. Just pick a number. So we're doing the numbers, and we're going to take that out, and we get that back. Rehab or acquisition or whatever over the years. And they'll say to me, well, so we're going to take that out. We're going to just invest the difference. And I'm like, no, you can't do that. I mean, you can do that, but you pay taxes.
Sure, you pay taxes on it.
So I tell them, think of it like a 401k, right? When you take a disbursement out of a 401k, all of that disbursement goes to the tax bill to the IRS first before you take your own stuff out. So
of course,
the idea is it's understanding those key factors when you're getting the numbers down is critical. A lot of times people don't realize that, and they educate a guess, or they think things, or somebody might have said something to them, or they read something online. It's not true. It's partially true, but not fully true, if you know what I mean. So when we talk to them, we want to get the whole lay of the land up front.
Of course. In the section that we have here, we cannot put everything in. There's so much to talk about.
Yeah.
But the summary here, folks, is that I think you're getting a basic, or actually a very good understanding of the whole process of this 1031 exchange. And that is why it's so important for you to, before you think about selling your investment property, consult with the expert. Come to us, see us. You have Drew's information right in the system. You can call him directly or call me. We'll set a meeting and we'll do something that you will save a lot of money over this process, done the right way. So pre-planning, strategically pre-planning is a must. It's a must.
A must, and it's actually it allows it to be less stress, and it's a fun process. You really get excited about doing it.
There's no doubt about this, Drew, because when you pre-plan, you get you take everything out of the way up front, so that the process down the street is just a nice road to ride. Hopefully, you find the right property. But if you don't, at least you got the biggest hurdles out of the way.
Exactly right.
That's the most important thing, because a lot of people, like I am dealing with a few clients right now that, waited for the last minute, actually beyond the last minute in the process, which when it's too late, they can't do it anymore. And now they're going to be hooked for a lot of money.
I can tell you that point. We've had clients the same way. And after they work with us one time, they don't typically do that anymore. It kind of it doesn't cure it.
Learned,
it doesn't cure it, but it gets them motivated to go earlier on their own.
It's costly. And no matter what you do in anything in life, you get late, it'll cost you always something.
Yeah, you're running behind.
You're running behind.
Yeah.
You get into traffic because you're running late. You miss meetings. You miss flights. Yeah, everything. It costs you dearly.
Exactly right.
It costs you dearly. Right. So pre-planning, especially here, because it's going to hit your pocket big time. It's going to hurt you.
And it doesn't have to.
It doesn't have to. It's so simple at the same time, but it requires strategic pre-planning.
Absolutely.
Very important.
Yes.
All right, so keep on going. Do you
we
have
have
a lot of things?
We have a couple more things to talk about. Can I talk about?
Yeah, absolutely.
Partnerships or FRIPTA? Which one do you want to talk about?
Oh, yeah, we talk about FIRPTA. Foreign investors,
Yes,
we
go
have a
ahead.
lot of them around here.
Yep.
I mean, throughout the United States, but a lot of them in Florida. So these are investors that come from overseas. They don't necessarily live here, but they buy income properties, and either their residential income or their commercial properties. How does it work when they sell? Is it the same process? Is it different? What should they do?
So it's interesting. It depends on what their tax status is, right? So some people come here, they establish a business because they want citizenship.
Right. So let me clear that. Let me clear that. Under corporation, they establish a corporation here, a domestic corporation in the state of Florida.
Right. Wait a minute. Tell us more about it. So they tell them, I'm going to do a 1031. I know there's going to be withholding because remember, when they're a foreign national and they're not part of the tax system, the IRS will require either the buyer or most likely it's really the title company to hold back 15% gross.
50.
15. They're going to hold 15% gross. So if the contract's $1 million, they're going to hold $150,000.
Yes. Because
they want to make sure the taxes are paid on that sale.
There you go.
Because if you're a foreign national, you're not filing a tax return. How do they know you're going to do that?
They got to play safe.
Exactly right. And usually the 15% gross is way more than the gains tax would be. Okay? So the idea is that when they do this, they have to preferably hire a CPA to file the paperwork and say, yes, we're going to be part of the system now, and we're going to do this exchange. And when we prove to you that we didn't have a taxable event, we're going to ask you to send that money back to us. Now, the challenge with that is not just that, is they're going to hold that 15%, right? So if they don't get that 15% back in time for the exchange to finish, the account is short $150,000 in that scenario.
Right.
So their only option is to fund that themselves. So they're going to have to fund the 1031 account with what's short, that 15%, in time for the purchase to happen. A lot of people don't realize that, and it could be really a tough thing for them to do if they're not ready to do that. Exactly. But they'll get their money back once they file and say, yes, I finished the exchange. Now all that was held back, they come back to them. But that's the biggest takeaway with dealing with a FRIPTA holdback, because it's too much money to just say, oh, I'll just pay tax on it, because basically, guess what? It's too much. They're not
over the years, if you have made some money over the years, you pay it all back. You pay it all back in taxes if you don't do it right.
Exactly.
All the profit is going to be paid back in taxes if you don't do it right.
Yeah, so let me comment on that. I'm not sure I covered this before, but the taxes that are saved are basically two taxes. So let me just cover that and we'll get back to FRIPTA.
Right.
So when you sell a property, you take your cost basis, which is your real cost, just like any product, you want to know real cost. That's what you paid for it originally, plus capital improvements if you've done any along the way, less depreciation of the asset, right? So when you do that, that becomes your real cost. So at time of sale, you want to know, hey, what's my real cost? Let's say it's $100,000. I sold for $1 million. My $1 million is my net sale. So contract price less closing costs is net. So you subtract net cost from net sale, just like any other product.
Right.
That's your gain.
The gain.
You pay 15 or 20% of that
on the gain.
On your income. Exactly.
On the gain.
That's what's rolled forward with the 1031. Here's the other thing. If you do depreciation, you know how you depreciate the asset?
Of course.
A little bit every year, right?
A little bit every year.
When you sell it, the IRS says, wait a minute, that's not a freebie. Add up all those credits over the years that you've taken them. We want 25% of all of it back.
Ooh.
Yeah. So you have 15 or 20% of the gain, depending on your income, and the 25% depreciation.
Depending on the size of the
that
property.
That could be a shocker.
That could be, and a lot of people don't know that.
Right.
This is why pre-planning is so important.
And if you take that with the exchange, it all defers. But the foreign national, we want them to get the benefit too.
Right.
They don't have to be a citizen to get a benefit. That's another takeaway. They have to become a taxpayer to take a benefit.
Taxpayer.
So that's the key.
So the best way for a foreign national is to invest here is obviously to open up their own corporation in the
That would
state.
be an idea, yeah.
Okay. What happens if they buy a property? They open the corporation in the state of Florida, but they buy a property in Texas.
No problem.
No problem.
Still federal toll.
Still
federal. Yep.
There you go.
Now, Texas might have its own
implications on
tax.
each state differently because state taxes are different from one state to the other.
Exactly.
But on the federal code, it's all the same.
Same.
Federal level is all the same.
Doesn't matter. Exactly. So they be aware of that too. I mean, it's part of the whole picture, and that's not a surprise because the state has what it has, right? You said
Right. Every state has its own rule. So the other question is in partnership.
Yeah.
And this is a real life example that happened to me, but I wanted to bring this up. Say, for example, I have a couple partners, and all of a sudden, we put the property on the market for sale because we wanted to split the partnership. I don't want to be partners with them anymore. They don't want to be with me. So we decided to sell the property, take our profits, and then go. But in the meantime, now we thought about, oh, yeah, I don't want to pay taxes, so I want to do a 1031 exchange.
Exactly.
How does that work? What's the impact?
So depending on how it's set up, the partnership could be a partnership itself, an LP, could be an LLC with multiple members, or it could have an S Corp or a C Corp with shareholders. So depending on how it's set up, it depends on different ways you can go. Now, the takeaway before we get into it is it's a concept called vesting, which means the taxpayer of the sale has to be the taxpayer of the buy. So if you're selling...
Taxpayer of the sale.
Correct. So whoever's selling the property, that taxpayer is on the hook for the taxes, right?
Right.
So they have to not only start the exchange to get the tax deferment, they have to finish by taking the purchase in title to that entity.
The same name.
Same name, same taxpayer,
Same
not
taxpayer.
necessarily the same name.
Oh.
So let's play that out a
Same
second.
taxpayer. So
Same
identify the taxpayer there. Is it the individual or is it the corporation?
If the corporation on title, it's the corporation.
Oh, there you go. So it doesn't necessarily, if you have 3 or 4 partners, it's not on the individual. It's
They
on
don't
the
own real
corporation.
estate. They own shareholders.
They're
or
shareholders.
membership interest or partnership interest.
It
Depends on the
They own a
structure.
share of the property. Let's make it in simple terms. They own
Exactly.
the share of the property. But the corporation pays the taxes in. So it's kind of like the same exchange. You have to, if you sell, you have to buy in order
Correct.
to defer it.
But let's look at when you separate, though.
Aha. Now
So let's
the big
say the
challenge
most
comes.
common thing we run into, and tell me if this is what you had, an LLC with multiple members that wants to dissolve, just like you said, right? Here's the challenge. If the LLC is 2 or more members, then now the LLC is the taxpayer. So you have one taxpayer selling. It has multiple owners within it, but it's still one taxpayer selling. So if it sells, it has to buy. But wait a minute. If it's dissolving at the sale, how's it going to do that?
How is it going to buy?
It can't do the exchange. Because it won't be existing.
During the process before buying, the corporation is going to be dissolved because the partnership is.
So that won't work for the exchange.
They're going to go different ways.
That won't work.
That will not work.
So
the IRS will not give you a chance for part of it or a quarter of it or half of it.
So let me tell you a couple different ways to work it. So one way is, again, remember
that's
huge.
very, very delicate right there.
Exactly.
This is very important and it happens all the time.
I run into this every week, like all the time.
Look how common this
Multiple
is.
times.
Man, it's even bigger than I thought.
It's a very popular way to own real estate with partners.
Of course.
So here's how, there's 2 options how to handle it that we know of, okay? First option is way before, maybe a year or 2 before you sell. And we're talking strategic back. Before you think of selling, you have an exit strategy that says, you know what, next year we want to sell and we separate. You take your money, I take my money, we go. Whether it's, whatever reason, doesn't matter. That's what they want to do.
Whatever reason it may be, yeah.
So if that's the case, the best scenario is a year or 2 before they sell, they transfer their membership interest to a title interest. So there's no taxable event.
Very interesting.
So they say, okay, I have 25% of this LLC that owns that property right there. So I'm going to take 25% of my membership interest and take title to 25% of the property. And then the other partners do the same thing. Now the LLC goes away, or it could stay on to operate, but doesn't own anymore. Doesn't own anymore.
Doesn't own it anymore.
Now we have the owner's own.
Individual interest now.
Exactly
you
right.
You dissolved the LLC in the process and you created individual interest.
Tenant common interest. No problem.
Exactly.
Then when they sell, it's a no-brainer. Now we have number of whoever's on title. They sell, they get their share, and they do whatever they want with it. They want to do an exchange?
Can one of them do an exchange?
Sure. And the other one doesn't have to.
The other one that doesn't has to pay their share of taxes.
Because they're their own title.
They are, exactly. They're their own title.
So that's the best scenario. Guess what? Most times I don't run into the best scenario.
9 out of 10
Because you have
times.
to think 2 years.
Because they fight so long and they don't want to deal
or
with
they
it.
don't. They don't realize.
They don't think of the. They don't think of the. See, this is big stuff.
Exactly right.
This is huge.
This is
stuff.
very normal. Now,
I mean,
and how do they don't think the exit strategy affected 1031. They might not even know about the 1031. So that's the issue, right? So most of what I deal with is the second option. Okay? The second option says, well, we're closing in a couple of weeks or a month or whatever, and we're going to separate. But I want to do an exchange. This person doesn't or that person does. Can I do that? The answer is yes and no. Here's how to do it.
Okay.
Here's how to do it. A couple different ways, but mainly this. Some people will say,
even though before dissolving the company, dissolving the LLC, the corporation, now at the time of the sale, they want to do it after it's already under contract and all that stuff. Just
closing's imminent. Closing's coming up.
It's coming up. So
exactly. So what I tell them is, don't do any changes at that point. I'll tell you why.
Don't do any exchanges at that
point. No, don't any change. Don't any change of title.
Title.
Because here's the thing.
Change of title. That's
exactly. So if you, let's say you want to do that thing about putting on title like we just talked about a year ahead of time.
Okay.
They say, no, we'll do the quick claim deed, and we'll each take a piece of the title now, and a month later we'll do the closing and do it that way. Here's the problem with that. Is it easy to do? Yes. The problem is the IRS is going to say, wait a minute, before we had ABC LLC on title, and Paulo and Drew and whoever else, let's say it's just Paulo and Drew, right?
Right.
Now the title went to just not ABC anymore, but Paulo and Drew on title. Paulo and Drew on title for 1 month, and they sold the property. They just flipped the property. You can't flip a property in a 1031.
Do it. You can't flip a property in a 1031 exchange.
No.
You're going to get taxed.
You need to show the IRS that you use it, remember, to make money.
To make money.
Or to run a business out of it.
Is there a grace period right there?
No.
You can't do it at all. Going forward, you can't.
Well, you can, but they won't like it. They'll bounce it, probably. Because you didn't establish.
Not even if I own it that way for 2 years or 3 years?
1 or 2 years better. Longer better. They don't have a holding period. But if you're telling me you're using this property to make money and you owned it 1 month and sold it?
No, of course, then there was intent. There was an intent right there.
It's intent to sell. We say you should have an intent to rent, not intent to sell. Intent to rent is rental.
The IRS is going to look at that, okay, yeah, they did this to get away with taxes, but wait a minute, not so fast. You're a little smarter
Property
than
flipping is treating real estate like inventory.
And
if you treat real estate like inventory, phones, desk, whatever, you buy it low, sell it high. That's profit, not gain. You can't defer tax on that.
That's different.
If you treat real estate the same way, you can't do it. Now, that being said, just to kind of tie that together, is that you want to show what we call seasoning. So if you're closing in a month and now you're going to disperse the title from an LLC to individuals, now you're going to own it in a month. We say don't do that. You could, but the IRS will probably bounce it.
Wow.
How do you prove it? So we say another idea would be, is that maybe the partners get together and have an agreement with each other, especially if the taxes are very high, okay? And you say, listen, we want to do the 1031, but we don't want to do it together. So maybe we have a management agreement that says we're going to have the LLC buy a property for each one of our shares. So I'm going to, let's say I have.
You can split it in different ways.
Yeah, let's say the LLC buys.
According to whichever amount you walked away with from your share.
Exactly right. So let's say it's you and I.
Yeah.
Let's say it's $1 million property. And I say, I'm going to have the LLC buy $500,000 worth of property. The LLC is going to own it, but I'm going to have the benefits and risks. That's the management.
500 for you, 500 for me.
But the LLC owns both.
Right.
But if I lose money on this, I can't go to you anymore. And if you make money, I can't go to you either.
So I see.
So you let that run for 1 or 2 years. The LLC is still intact. Then you do the quick claim deed or the warranty deed to get the property into your own name. So it's the same thing as before, but give it time.
That's so
I had an attorney give me that idea one time. I'm like, wow, that's a great idea.
That's very
Some people, though, if they're not getting along, they won't wait the 1 or 2 years, though.
Wow.
So it's a reality check. We have to have that conversation, basically.
Very important. Drew, we are at the top of our hour. I want to give you the opportunity to do a wrap up here and to give me a little summary in a minute or two.
Okay.
Some of the most important things very quickly that why they need you.
So I want them to consider about this as a problem solver to enhance and strengthen your portfolio, even if you only have one property. I don't want them to feel nervous about the IRS. I don't want them to feel anxious about it. When they're properly planning this and they have the right information relative to their situation, it's a very smooth process. It's a very exciting process. And it's a very valuable process for them in building their estate to multi-generational wealth building. We can talk about that next time.
Absolutely. Listen, I want to thank you so much for being here, or taking your
Thank you
valuable
as well.
time out and bringing such powerful information here to the audience. I got to tell you, this is so, so important. It took me a long time to get somebody that qualified like you are to bring on this show, because it's that important. To me, everything is about bringing value to my clients and to everybody else that's out there. Because that, for me, if somebody calls me tomorrow and say, hey, you know what, because of you, I saved this much, I've done my job.
Exactly.
I've done my job. And that makes me feel that I am, that's part of the reasoning I'm in this industry. And so to make sure that people benefit from what we bring to the table.
Love it.
That's what I wanted to. So thank you so very much. And for those of you out there, contact us, get in touch with us. You have Drew's number right there. You want to call him directly, get in touch with him, find out the reasoning, pre-plan, because it's that important. You saw it all. If you need to see this video again, go through our site, go to Paulo Schneider. We are our YouTube channel. It's going to be on the screen. All our contact is going to be there. Consult with us. You will not regret it for one moment. It's going to be that important. And share this video to everybody out there, to anybody around this world. It could be in Mars sometime soon, right?
Exactly right.
But thank you again for being part of our show. Drew, once more again, thank you so much.
My pleasure, and I appreciate you as well, Paul.
We'll see you soon with great information again. Thank you.